We're just so happy with our first rental property. Everything went exactly as planned. We're cash flowing $500 a month, and we were able to refinance and take out all of our money. And now we're looking at 5 more houses just like it. We've made negative $3,399. Hey everyone, welcome to my channel. My name is Kim and I'm a software engineer and real estate investor. Today we're going to be talking about our first rental property. We're going to be going through all of the details, how we bought it, how we rehabbed it, how we're managing it, and we're going to go over all of the numbers. Please stay tuned until the end of the video because I'm going to be sharing my mistakes and lessons learned for the next properties. Our first rental property is a 3-bed, 1-bath, single-family home in Milwaukee, Wisconsin.
But wait, don't you live in Seattle?
You're right, we do. And we've never even been to Wisconsin. So, how did we buy it? Well, back in the before times, we used to go to monthly real estate meetups. One of the investors there referred us to a brokerage which collects off-market properties and puts them in an email list. This was great for us because we're both working full-time and we felt like we didn't have enough time to analyze markets or properties. So one day in June 2020, we got an email that looked like this. A few things drew us to this property in particular. 1, it's located in a city that we've heard of. 2, we were able to afford both the purchase and rehab costs without using a hard money lender. We thought this would decrease our risk because if the project went over time or over budget, we didn't have to owe anybody anything. 3, it didn't really need much rehab. We thought this would be better because we were in a new city and we didn't really know any of the contractors there, and we didn't want to take on a huge project with an unfamiliar contractor. And 4, the rent to purchase price is 2%, which is very good cash flow in comparison to the properties that we've seen in Washington. So this is the spreadsheet we use to analyze properties. The purchase price is $44,900. We are funding it 100%. Rehab $5,000, also funding it 100%, and expected ARV at $60,000. We're not using any hard money, so none of this applies. Our total acquisition cost is $50,900. And for holding costs, that's taxes, insurance, HOA, utilities, and hard money lender payments. That's a total of $344.67. We assumed about 3 months before renting it out. For refinance, we expect to be able to take out 80% of the value of the home. So that's 80% of the ARV, which is $60,000. So that is $48,000 pulled out, and subtracting all of the costs such as the rehab and the holding costs, we expect to leave $3,244 in the deal. For our long-term financing, we were going to get a 20-year loan, which is typical for a commercial loan at 6% interest rate, expecting the rent to be $900, which was on the lower range of what the email said, and management at 8% and 5% for vacancy, repairs, CapEx. And this is what the mortgage would be. So the monthly expenses would be $550.89 for a monthly cash flow of $349.11. That's a cash-on-cash return of 129.12%, which is pretty good. After our initial analysis, we decided to just jump in, and any mistakes we made along the way, we'll just count it as tuition, the cost of learning how to invest in real estate. We offered $44,000 cash with an inspection contingency, and we got accepted the next day. After our offer gets accepted, we have a due diligence period of 10 days, which means we're allowed to bring in inspectors or contractors to walk the property. We just decided to bring in an inspector who we found on Yelp, and they came back with a list of things to fix. There wasn't really anything alarming in the report, just a little bit of leaking in the basement, which was due to the gutters not being placed properly. We decided that this was going to be a minor fix, so we decided to just go through with the property. We closed in July of 2020. For the rehab portion of our project, we decided to ask our real estate agent if he had any recommendations for contractors or property managers. He led us to a property manager who had an in-house capital improvement team, which was a huge plus for us as out-of-state investors. We didn't have to lift a single finger, and we didn't have to manage any part of the project at all. Their rates were also pretty reasonable at $400 placement fee and 8% management fee. Honestly, we stopped looking for PMs because this came as a referral, so they must be good, right?
Right.
So we signed the management contract with them, and they walk through the property and come up with a bunch of line items for rehab. A lot of it was purely cosmetic, like paint, new floors, reglazing the tub, but they didn't address any of the big ticket items that I wanted to be done, such as the gutters. They quote us $8,690 for a full unit flip. Also around this time, the excitement started to wear off, and it really hit us that we just bought a property, sight unseen, in cash, in a state that we've never even been to. I started to get really paranoid about what the house was really worth. Zillow estimated it at $22K, so that didn't really make me feel good. I emailed the agent and asked for a list of comparables to make myself feel a little bit better. I know I should have asked a long time ago, way before we even put in the offer, but I was just so excited. When the comparables come back, my stomach just dropped. Remember how the email said that the ARV was somewhere between 60 to 69K? Well, those numbers were based off of listing price, not sold price. The houses around it were actually sold for much less than what was listed. According to the agent, the house is worth maybe 55K. So now we have a house that is worth less than we thought, and we have a PM that hasn't talked to us in a few weeks. When they finally finish rehab in August, they send me some pictures, and honestly, we're a little bit disappointed. The walls are painted, but they kept some of the original hardwood floors, which wasn't in the greatest shape to begin with. I also noticed that there's huge gaps in between the baseboards and the floor, which means it's very drafty. Also, they haven't even fixed the gutters yet. I asked these things to be fixed, but they tell me that they already have a tenant moving in the next month. On the one hand, it's great that they were able to get a tenant in so quickly, but on the other hand, I felt kind of bad that the house wasn't really up to the quality that we were expecting. We want to be able to treat our tenants to a nice, safe, comfortable home, and I felt like there were some room for improvements. We decided to just let it go because if there was somebody willing to pay above market price and to move in quickly, then it must be good enough. Let's take a look at what really happened. In the month of August, we did not receive any rent, but they did place a tenant, so that's $400, and they replaced the key and lock. Here are some other supplies. So total expenses was $670. In September, we finally got our first rental check. Woohoo! Management fees at 8%. And this is utilities from when we were holding the property, but there was nobody actually living there. So this was a net positive month. October, $895 for rent. General cleaning and maintenance, let's see. They bleached the basement floors for some reason. I didn't really ask about that. Okay, actually, October was the first month where it got a little bit weird. They reported that the rent collected was actually half of this, $495, so the management fee was 8% of that. But that was actually their bad, because what actually happened was $400 was to buy a stove from the tenant. So the stove was bought by the tenant and reimbursed by the property manager. So this is the way it should have been reported, but that's on them. So okay, we have a new stove. In November, there's rent coming in, management fees, and repairs. There were a bunch of problems with the heater. They said that they cleaned the chimney. They bought supplies for pine trim, weather strip. I suppose this is to seal around the windows. And a new refrigerator came. So here are all of these capital expenditures just coming right in the beginning of our rental property's life. It really should have been taken care of during the rehab process, but I felt like they moved way too fast. So now the tenant was calling and complaining about things not working. So they have to deal with that. So this is a negative month. In December, they charged us $615.48 to fix the HVAC. But when I contacted the tenant directly, she said that it still wasn't working and it was winter in Wisconsin, which is very cold. So I got worried and I just took the matters into my own hands, called a heating company myself and replaced the furnace. So that was $3,554. And this negative 100, that was them reimbursing us for the refrigerator. They said that they overcharged. So now we're running at negative $3,421.67. And in January, which was our first positive month in a while, they made repairs to the gutter. This is just materials for the gutter and other things. And they reimbursed us for the water bill. And, whoop, this is not correct. This should be $0 here because we already paid for it. And net income is $402.32. So grand total, we are still operating at a net loss at negative $3,399.80. Let's take a look at that spreadsheet and compare. So we bought it for $44,000 and our down payment 100%. Rehab was way more than $5,000. It was actually $8,690 for the unit flip. And I'm just going to include the appliances and the HVAC as part of rehab. And the ARV is actually lower at $55,000. So that means our total acquisition cost is $59,177.46. So notice that is more than the ARV. Our holding costs, actually we only had holding costs for 1 month, which was 2 months actually, July and August, when there was no tenant. So these are the holding costs. We have not refinanced yet, so we're still $59,504 in the hole. The rent is a little bit lower at $895. Property management 8%, vacancy 5%, repairs. Let's take a look at the average repairs in the past few months. $549. Yeah, that's quite high. Hopefully it won't be that much going forward. Yeah, if I were to put that in here, then we would definitely not be cash flowing. So maybe 250. And CapEx, since we already replaced all of the big appliances such as the stove, refrigerator, and the HVAC, I think we can keep this at 5%. Maybe save 10% for CapEx. And since we paid all cash and we haven't refinanced, our mortgage is $0, HOA is $0, and nothing else. So our monthly cash flow is $439 if it's a good month, and that's a cash on cash return of 8.86%. So that's $439 times 12, which is our annual cash flow, divided by how much is invested already. But if we refinance, and let's say we are able to take out 80% of the value, then we could pull out $44,000, and our cash on cash return would be 9.59%, with a monthly cash flow of $123.92. So it's not that much, and even though the cash on cash return has increased, that means our monthly cash flow has decreased, and that's because now we have a mortgage attached to it. So yeah, let's compare expectation with reality. So it was not as smooth as we thought, but we did learn a lot, and here are some lessons for next time. Trust but verify. We shouldn't have taken those numbers at face value, and we should have verified everything in that email. We should have asked more questions to our agent before putting in an offer, and we should have verified that the comparables were of sold prices. During the due diligence period, we should have had a contractor walk through the property, so we would have had a more accurate ARV. We also should have interviewed more property managers before settling on one. After having 6 months to reflect, I've decided that they're not necessarily bad, but their management styles and our management styles just don't mesh really well. We're more hands-on investors who really want to know what's going on with the property, who the tenant is, and to be notified of big purchases. Whereas they work with investors who maybe don't really care as much and trust them to do what is best. Having too much money made us a little bit more impulsive. We definitely could have slowed down a little bit and thought through the numbers a little bit more. For our next deals, we'll be using hard money, so that means our deal analysis has to be on point. Buy a more distressed property. In order for BRRRR to work, we need to be able to add value. Just painting it is not going to cut it. And finally, don't be desperate. Be willing to let a deal go. All in all, we're grateful for this experience, and it's because of this house that we're actually able to call ourselves real estate investors. I think in time, this is going to be a great cash flowing property. Hope you all enjoyed this video. I'll see you all next week. Bye.